Yesterday, nothing dramatic happened in the market. No crash, no big rally. FI sold, RBI didn't change rates, US markets were weak, but India just stayed calm. Everyone says that's a good sign, but somehow it doesn't feel like one. What's actually going on? You are asking the right question because markets don't become dangerous when they crash, they become dangerous when they stop reacting. Understand till the end what happened yesterday matters more than what people realize. Let's start with the obvious. FI sold again, global markets were volatile, crude moved, the dollar stayed firm. Normally, that combination creates pressure. But yesterday, the market didn't fall. That tells us one thing clearly: the market is not driven by excitement, it's being held together. When markets are strong, they rise easily. When markets are weak, they fall easily. When markets do neither, it means risk is being managed, not taken. Headline said FI selling again, but they didn't tell you the second part. Domestic institutions absorb that selling. That doesn't mean confidence, it means support. Support is defensive. Markets don't crash when sellers appear, they crash when buyers disappear. Yesterday, buyers were present, but only enough to prevent damage, not enough to create momentum. That's not bullish behavior, that's containment. Interest rates didn't change. Why didn't the markets relax? Because decisions matter less than the tone. A pause with comfort sounds different from a pause with caution. Yesterday's message was simple: liquidity will not get easier, visibility is still unclear. When liquidity doesn't expand, markets stop trending. They wait. Crude didn't spike, the dollar didn't explode, but both stayed firm. That's important. Markets panic on shocks. They adjust to pressure. Firm crude means patient risk stays alive. A strong dollar tightens the global liquidity. Neither causes panic, but both reduce the risk appetite. This is how pressure builds without noise. Indexes were calm, but protection got more expensive. That's the part most people miss. Big money doesn't buy insurance after fear, it buys insurance before movement. So prices stay flat, but risk increases underneath. Calm market don't always mean safety. Sometimes they mean everyone is waiting. Some sectors held up, others kept bleeding. That's not randomness. Money rotated from risk to safety, from hope to preservation. That's why portfolios feel uncomfortable, even when the index looks fine. Indices don't feel pain, investors do. This is not a bull phase, not a bear phase. This is a distribution and waiting phase. Markets are not rewarding aggression, they are punishing impatience. That is why breakouts fail, dips don't bounce hard, nothing feels convincing. This phase doesn't demand action, it demands discipline. The biggest mistake now is forcing excitement where none exists. Markets will speak clearly again. Until then, preserving clarity matters more than chasing return. Crashes are loud, this phase is quiet, and quiet phase decides who survives the next loud.